Good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, June the 11th, 2025, recording this in the morning. Today is CPI day, of course, but I just want to have a quick look and just see a little bit what's happening over from those talks in London. So I've got the Chinese text here of the official statement. And I guess we need the translation here. It'll be more useful. But the point I want to make here is that the Chinese seem to be quite downtoned. And just according to a good commentary I've got here, it says, overall, the tone moves from optimistic achievement to cautious consolidation. So the point is that moving in the sense of what the talks originally from Geneva. So if you look at the Geneva talks, you've got here, it says, that back on May the 12th, it says the talks were candid, and this is coming from the Chinese. The talks were candid, in-depth, constructive, achieving substantial progress and reaching important consensus. So, as this commentator says here, optimistic achievement. So the tone of the Geneva talks was pretty positive, and we saw a positive reaction in the stock market. Whereas if we look at the what happened in London, it says the two sides engaged in candid and in-depth dialogue, okay, thoroughly exchanging views on economic and trade issues of mutual concern, very neutral there. They reached a principled agreement on a framework of measures to implement the important consensus reached during the June 5th call between the two heads of state and build on the outcomes of the Geneva economic and trade talks. So again, cautious consolidation. I think that's a good characterization of it. And the point is that, we saw that Scott Bessent is already back in the US because he has to sort of testify before the House on another issue. But the point I'm trying to make here is this is no sort of huge sort of overarching deal, no sort of breakthrough, tariffs coming down, everyone's happy. It seems to be that basically China has said, we're going to do our thing. We're talking to the Americans, they have to respect us, and this is going to be a long, grinding kind of sort of talks. So with no sort of immediate consensus is the point. So, and it's interesting just to look at the stock market reaction here. Well, we're just looking at the VIX, first of all. The volatility is very, very low. So you see the volatility here has just been grinding lower and lower and lower. And you can see that's getting down to now almost about 17. And if we just actually look back, where we're going to go here. So I just want to look back at the vol curve, like the VIX curve here, which I have, I do believe here. Whoops. Yeah, so if you look at this here, you look at the curve here. So look at spot, you can see it's all the way down here, down to about 17. And you see that the curve here is in a pretty strong sort of contango state. So the market absolutely with lowering volatility and not particularly concerned. And if you compare that to a week ago, you can see here that the curve has come down and the pricing has come down. So the market seems quite relaxed and but the market is also not ecstatic in any sort of sense. So you see here that volatility is down. We also see that volatility in, let's say, something like oil is also coming down a lot. So the market seems to be really just at a pause situation. And if you look at the ES futures here, you can see that they didn't particularly, they're not collapsing on this news and they're certainly not ripping. It's a little bit of a shrug of the shoulders. And it's just kind of interesting now because we're getting this grinding sort of price action higher. And I've been doing a bit of research. A lot of the vol control funds, so a lot of the funds which sort of specifically target sort of volatility levels, as these volatilities levels go down, they're more comfortable increasing size. And I was reading something saying that if volatility remains on an average range of just about 50 basis points or so, over the next couple of months, they could be net buys of about 180, I think it was 170 or 180 billion dollars worth of stock. So the point is that things like sort of volatility control, sort of focused funds, they're quite enjoying this low vol, and they just tend to sort of slowly buy. And that's causing this slow sort of grind upwards in the prices. So I don't know that this is any kind of excitement here about, sort of the trade talks or tariff deals or the economic performance of the US. It's simply, I think, technical buying at this point. And you can see here that probably this looks as though it wants to grind up towards testing the recent highs. If we look on the NASDAQ futures here, you can see we're pretty close here. I mean, how far are we away from recent highs? We're only, about 1.5%, 2% away from recent highs here. So, which is a pretty incredible comeback. So the question then becomes, what's going to happen with CPI? So let's just have a look. And before we look at the CPI, let's just see what's been going on with the Fed. The market really is becoming more and more skeptical that the Fed will actually sort of do its two cuts. And if we just look here, let's just look at what's priced in. We can see that for the upcoming June meeting, absolutely nothing priced at all. Then if we even go out to the end of July, we can see only 3 basis points priced in of cuts, which is again is essentially sort of almost nothing. And we have to really go out to September to sort of get the pulse moving a little bit. We have, a two-thirds possibility of a cut, 16 basis points. And then it's only the first cut. It's really only priced then for the October meeting and then for December. But now we're down to 1.7, so not even two. If you remember over the last few days, the last few videos, this number is hovering around two. But clearly, if you look here, this is on a tick chart. And again, going back to June the 6th, which is non-farm payrolls, the market really at that point has just went higher pretty dramatically. And there's just as Bev referenced, there's two cuts at 50 basis points here. We were even at about 2.5 cuts at about 60, 65, as recently as 5 or 6 days ago. And you can see here that the market's now getting more and more comfortable, not only pricing out two cuts, but maybe even, getting down towards 1.5 or even one. And keep in mind that at the upcoming Fed meeting on the 18th, we do have an update of the summary of economic projections. And that's going to be interesting to see whether the Fed keeps their two cuts penciled in the dots, or whether they even take out one of them and go down to one cut, which of course would be pretty hawkish. But the reality is, if the CPI comes in, if the economic data continues to be fairly robust, which it has been, employment market seems to be, okay, although there are definitely signs that it seems to be sort of slowing if you look at it in detail, but it's still relatively robust. And so then it becomes like a CPI issue. And so that's the whole point today. Let's see. But the thing today is that if you look at the CPI month over month, we're expected to get 0.2. Ex food and energy, of course, that's probably the most important number here at 0.3. So that's even the market is saying that's going to sort of tick up a little bit, or consensus. And if you look year over year on the core, 2.9 going up from 2.8. So the point is we're still quite a long way from the Fed's sort of target, at least in the short term. And I was just reading something. We'll also get PPI tomorrow. But what's actually kind of interesting as well is just to look at where the market is thinking about longer term. And I'll just bring this up if you give me a second. Going to US macro. Yeah, I just want to look at the inflation swaps. Yeah, it's this one here. So what's interesting, let's just bring this up. Hopefully it will load. Yeah, there we go. So this is all the inflation swaps. So this is, again, what the market is trading on, where they think inflation will be. And if you look here, just looking at the different tenors, so here's the 1 year swap. So this is where the market thinks inflation will be. And so it's still thinking that in a year, it's going to be over 3%, coming down. It is definitely coming down. But then if you go in 2 years, down to 2.7, you got 3 years down to 2.6. And then down to 2 on the 4 years. Let's go out to 5 years, 2.5. Then if you go longer term here out to, let's say, 10 years, 2.4, and then on the 30 years. So the thing is that overall, the market seems to be saying that, within, let's say, 18 months or 2 years, the definite trend is for inflation to sort of get to trend down towards the Fed's target at 2%. The problem is in the next sort of 6 to 12 months. And the problem is for the Fed, and probably here also for the market, is that the market, you see 1 year out inflation swaps over 3%. The market is still not convinced that we're seeing the full effect of the tariffs. And the reality is that the tariffs, as we start to get new inventories, that's only going to start feeding into the real economic data, probably now in the next few weeks, 3, 4, 5, 6, 7, 8 weeks, as all of those old pre-tariff inventories have basically been sold off, and now new inventories and new supply will probably and possibly reflect the new levels of tariffs. So the thing is that even if there's some kind of de-escalation of tension with China, we still have, I was reading some research yesterday, we still have an approximate overall tariff level now of about 12 to 15%, depending which way you sort of look at it and calculate it. But 12 to 15% on tariffs is much, much, much higher than it has been for the last 10 or 20 years, where we're talking, 2, 3, 4, 5%, again, depending on how you calculate it from different countries and whatnot. So the point is that even if we don't have a further escalation with China and Europe and everything, the tariff level will ultimately seem to be higher, and that ultimately will become reflected in sort of prices. And that's going to be reflected not only in consumers having less free cash to spend, which potentially could be a slowdown on the economy, but it also means lower potentially sort of pricing power and profit margins for companies, which potentially is going to sort of slow down companies' performance. So again, we're at this interesting point that the real economy seems to be doing absolutely, okay, pretty robust at the moment. But it does seem structurally as though we're going to have a slowdown, but we don't have the evidence. And this is really what the Fed is waiting for, and possibly also the stock market. One other point, though, we'll make out is that I just wondered in terms of the bond market is where could the sweet spot be? Because remember, if we have tariffs which not too onerous, let's say 6, 7, 8, 9, 10%, that does mean that there's some extra income coming in and being collected by the US government, which ultimately could reduce the deficit, at the margin a little bit, which potentially could be good for bonds. And remember that if we have no tariffs, then ultimately you could say that there's no tariff income for the US administration. And secondly, potentially that wouldn't be such a sort of a drag on the real economy, which could be a more of a booming economy and less sort of income for the Treasury, which means maybe more issuance. So I just wonder, which potentially could mean higher long-term yields. So it's kind of an interesting sort of side dynamic that maybe for the long-term yields, maybe the sweet spot will actually be some kind of, sort of moderate tariffs, 4, 5%, which maybe the real economy and consumers can deal with, but it would actually give a little bit of extra income. Interesting. Okay, I just want to also look at oil. Just look at the chart here of oil. We had some comments that Trump is saying that he's finding it harder and harder to deal with Iran, and that maybe there's going to, it's going to be harder to achieve a breakthrough. So oil popped on that a little bit here. And I just want to sort of put up the oil chart. You can see we had a green candle at a pretty important sort of level here. If we just look on as some moving averages and whatnot. Actually, sorry, let me just bring up the EMAs. So if we just bring up the EMAs, the interesting thing for the bulls is that on the continuous contract in the WTI, so the American contract, the US contract, we had a bit of rejection at this important overhead sort of trend line resistance here yesterday, the 100-day moving average. But we've now broken through not only the 100-day moving average, moving above that, we've retested higher this trend line, and also we've broken this downward trend line here. So this is pushing up. You can see here that the 20-day and the 50-day moving average are starting to turn over as well in a positive sense. So that's looking quite positive for oil, and maybe this idea that there could be more sort of sanctions, well, let's say that the sanctions on Iran may not be lifted, which in theory, although we know Iran cheats and sells all of their oil sort of through illegal sort of means, but that does put up the price, and that could be a positive. So let's look at, we have this morning, we have the official government DOE numbers. There was a small draw last night in the API. So let's keep an eye on that. But sort of technically, this is looking quite good. And the other thing which I just want to look at, again, just on the technicals, a little bit more detail on oil, is just to see what do we have here? So we've got that's the VIX. Yeah, just want to have a look here. You can see that the spread here of Z5 to Z6, so December 25 to December 26, which the industry, a lot of people trade in the industry. You see here on a 60-minute chart, you can see that this is starting to push up. So that's in positive territory. So the point I'm trying to make here is that the oil curve is in pretty strong backwardation. The time spreads are looking quite good. And I think I also had, what's also interesting though, is just seeing the most popular or the most active options from yesterday, at least, in the oil market. You see, there's quite a few people buying calls, upside calls for August, $70. So they had quite a lot of volume. But it is interesting, though, the most active one with a volume of 11,000 was actually later in the year for 58 puts. So that's a little bit of a bearish sort of something there, or is that just a protection? I don't know if this is outrights. It's difficult to know, but definitely quite a lot of interest at the 58 strike for September. So could it be, and really what the market is trying to tell us, I think, also by looking at the curve, is that there's a bit of short-term tightness. We're in the driving season. It's the summer season. Remember that, especially like in the Middle East and Europe, and also in the States, there's a lot of requirement for energy, for air conditioning in the summer, also for driving. So this is peak kind of consumption. And it's just telling us that the market's a bit worried that eventually, as we move out of the summer into the autumn, that maybe we're going to start having builds in inventories as those extra Saudi barrels and the OPEC plus barrels, they start to sort of flood the market. So it's interesting here. Maybe, oil could push up for another month or two and then start to fall off a little bit. So let's keep an eye on that. Apart from that, Not a huge amount going on. As I say, volatility is very low. So sort of volatility structures are really, people sort of selling vol. The bonds are just sort of grinding low if we look at the 2 year. And just grinding lower again. Sorry, this is the 5 year. And if you look at the 2 year, and again, just getting back to the CPI, I think just quickly, the reaction would be obviously a hot number is going to be hated by the front end. But having said that, the front end has come down quite a lot. You can see the 2 year here, we've come down quite a lot here. So the front end, I do believe can fall off, but I think potentially that could also be the belly of the curve, which gets hit the most. A soft number, again, I believe, obviously it's going to be good for the front end, and we could get some kind of sort of bull steepening there. But the question is, it's going to take at least 2 or 3 consecutive good inflation prints, so low inflation prints, really for the Fed to start getting more comfortable about cutting. So I think the market understands that. The market has repriced in a fairly hawkish way over the last sort of 10 days or so. And I think, today we have to see it not so much as a game changer for the Fed, but kind of another brick in the wall. Either if it's going to be a little bit hot, that's going to really solidify the fact that maybe the Fed will only cut, let's say, once this year at this point. And if it's a cool number, for sure, that's going to be positive for the bonds. But it's going to be sort of an incremental process. And maybe, for example, on the December 25 SOFR pricing, we'll go from 1.75 cuts, maybe just up to 2 cuts. So nothing too dramatic. So that's it. Okay, we'll leave it there, guys. Got CPI to prepare for. Have a great day, and we'll keep the conversation going. Thank you.